Millions of diaspora citizens hold significant wealth offshore, yet when they try to deploy capital home to fund projects, they hit a wall. The local lenders aren't turning them away because the capital is fake or the liquidity isn't there. They are turning them away because of structural regulatory friction. This friction starts with Basel III and IV. Onshore banks face heavy risk-weighting penalties for direct exposure to offshore assets. Furthermore, strict local anti-money laundering laws actively ring-fence domestic credit markets, blocking foreign collateral. Because of this paradox, raw offshore capital cannot directly collateralize an onshore loan. It requires an engineered intermediary to cross the divide. The most common assumption in fintech is that to solve this, you simply build a digital platform and lend directly across borders to retail consumers. If an offshore entity lends directly to an onshore resident, domestic regulators immediately classify that platform as an unlicensed shadow bank. Sigma BankAI developed an architectural alternative to bypass this trap, the two-tiered trust bridge. This model abandons the idea of direct retail lending entirely. Instead, the offshore institution pivots to operate strictly under a wholesale guarantee structure. To safely mobilize offshore capital, a neobank must stop trying to act as a retail lender and start acting purely as a structural credit enhancer. Bridging the Basel regulatory gap requires a strict three-layer architecture. The foundational layer is a Class A offshore credit institution acting as a merchant core. This specific license carries a rigid operational constraint. It is legally permitted to issue wholesale trade finance instruments, but it is strictly forbidden from taking retail deposits or making retail loans. For capital adequacy, every instrument issued by this core must be backed by a 100%. The final layer provides the interface to the onshore market through a correspondent fronting model. Here, there is a hard legal separation of duties. A licensed onshore bank is the sole entity that originates the loan and manages the retail borrower under domestic consumer law. Sigma BankAI's exclusive role is to act as a guarantor. It issues a surety instrument to underwrite the onshore bank's risk. By separating credit origination from credit underwriting, this framework completely bypasses the shadow banking trap while safely mobilizing offshore capital. The remaining mechanical problem is how the onshore bank's risk department actually verifies and accepts this offshore surety instrument. The standby letter of credit must be transmitted via SWIFT MT760. This is the secure interbank telecommunications protocol standard for guarantees. Legally, the instrument must be strictly issued subject to UCP 600 or ISP98 standards. These international standards are non-negotiable because they legally bind the offshore entity, guaranteeing that the instrument is fully enforceable in the onshore jurisdiction's courts. Because the instrument is highly standardized and legally enforceable, the onshore bank can reduce its Basel risk weighting on the underlying loan down to zero. The SWIFT MT760 protocol and UCP 600 legal standards are the structural load-bearing pillars that make the entire trust bridge functional. Let's trace a transaction. A citizen's capital enters the RegTech shell for AML verification. It locks within the wholesale core as a cash-backed reserve. The core mints the SBLC, transmitting it via MT760 to the onshore bank. The bank then disperses the local loan. This sequence cleanly converts isolated offshore liquidity into active Tier 1 compliant onshore credit. The true power of this framework lies in decoupling credit origination from credit underwriting. As more transactions occur, cross-border risk transforms from isolated bets into predictable statistical data. This allows institutions to create rated, syndicatable portfolios of diaspora-backed credit. Under this model, the offshore jurisdiction operates not as an opaque haven, but as a highly regulated, neutral zone designed for global credit creation. By adhering strictly to global protocols and architectural discipline, the Sigma framework allows global citizens to safely underwrite the economic future of their home nations.